conversation with who better than Saurabh Mukherjea at this point and figure out what is it that investors should be doing. Saurabh, hi, good morning, and thanks for patiently waiting by while we were all listening to the HDFC Bank on call. But first, let's start off with that, Saurabh. How do you, wrap your mind around what's happening at HDFC Bank now?
I think at one level, it's simple to wrap our minds around this. This is power play of at the highest levels. I think Keki and Sashi did a spectacular job on that call. If you ask me, it's a difficult situation they've been put in. We are large shareholders. It's one of our largest holdings, has been for many years. We have very high faith in the executive management of the bank, and whilst I understand that the exiting part-time chairman has his views on HDFC Bank's ethics. Given what I've seen of Indian banking, if someone has issues with HDFC Bank's ethics, I think they need to take a deep, hard look at the rest of the banking sector. So we'll stay shareholders. It's a difficult situation, obviously, for the board, for the incoming chairman, Keki. We wish Sashi the very best. But this, to me, looks like power play at the highest levels. And it is one of those things. If you build a great institution, as the hardworking people in HDFC Bank have done over the last 30 years, if you build a great institution, there are plenty of other people who covet the levers of power at that institution, and it's one of those things, I guess, you have to accept in a free market economy, that there will be other people who want their hands on the levers of power at HDFC Bank, and all of us today are witnessing the play for the control of the levers of power in HDFC Bank. So we'll carry on being shareholders. We'll obviously watch the situation. We spend a lot of time traveling around the country, meeting branch managers, zonal
Recording
managers.
stopped.
We plan to spend a lot of time traveling around the country, meeting branch managers and zonal managers at various banks in India, including HDFC Bank, and we'll carry on doing that.
Saurabh, many a times in instances like these, it's also a function of the price that you bought a stock at, right? But let me twist the question. Would you be tempted to buy HDFC Bank or add on to existing positions at the current juncture?
Yeah. So just on that, we've been holding HDFC Bank for 8 years now. So that the valuation issue is less of a concern. In fact, when the stock sharply corrected after the merger, when the stock sharply corrected after the merger, we had increased our position. And then it had recovered to a decent level and we had taken some profits. But by and large, I don't think HDFC Bank's current valuation is a challenge for anybody thinking of coming in. As I said, we'll watch the situation. My reckoning is, given that the seriousness, that this is the exiting chairman and he's put the word ethical in his resignation notice to the exchanges, I think the RBI cannot but get involved in some shape or form. And if that RBI interference then leads to further correction, that could open up significant buying opportunities in HDFC Bank. Our reading of the situation is on the asset quality front and on the liability gathering front, HDFC Bank is as good as it has ever been. So on the ground level, operational aspects, there were some tech concerns. 5-6 years ago, there were some issues RBI had with HDFC Bank's technology. I think most of those operational issues, the tech issues, are behind us. Operationally, this is a well-run bank. But if the exiting chairman is saying ethical issues, I can't see how the regulator can just say, well, let business as usual carry on. And if the share price corrects materially, there could indeed be a big buying opportunity here.
Saurabh, how do you look at this entire situation with HDFC Bank from a point of view that for the last couple of quarters, we've been hearing about whistleblower letters being written to the board. There's some whistleblower letters which were out in the open as well and reported as well. And now, even if it's, a power struggle at the top, the board was not able to resolve this issue. And that
it's difficult, right? If you have vested interests who want to grab the levers of power in any institution in our country, right, whether it is Marcellus or HDFC Bank, these sorts of tussles for the levers of power in highly valuable, very public institutions such as HDFC Bank, they will play out, and they play out, unfortunately or fortunately, they play out in the public domain. And it's not apparent to me what exactly Sashi or Keki can do to suddenly say, well, we will now put a lid on all the whistleblowers for once and for all. If there are discontented parties inside the bank, or if there are other people outside HDFC Bank who covet a large stake in HDFC Bank, it is relatively easy for them to create the perception that there is something awry with the bank. I think that's what's being done here. The perception that's being created is that there's something awry with HDFC Bank. As I said, as shareholders, we don't think that's the case. Our research, and we spend a lot of time looking at this, our research doesn't suggest there's anything awry. But hey, who are we? We are just minority shareholders sitting on the outside. If the exiting chairman is saying he's got ethical issues, we hope that the regulator will look into that and give the public reassurance on that as quickly as possible.
True,
Saurabh,
because
the other thing is also the collateral damage of HDFC Bank on some of the other banking heavyweights as well. Now, we all know that the street was extremely skewed and tilted towards PSBs. That's where you had growth visibility. That's where you had valuation comfort as well. Would you use or recommend using this decline right now across the banking sector and the overall market as well as perhaps an opportunity for PSBs to be lapped up?
An interesting point you make, Aisha. If you think about it, right, in the last 2 years, barring now, if you leave aside ICICI Bank and perhaps Axis, if you leave aside ICICI and Axis, pretty much all the private sector banks have had some sort of challenge, right? We saw recently the IDFC Bank issue. A couple of years ago, it was Kotak Bank. In between, it's been IndusInd Bank. And my hunch is there'll be plenty of other private sector banks who'll be in the news for all the wrong reasons in the coming months. So it's very interesting that the public sector banks seem to post pristine asset quality growth on both sides of the balance sheet. I think the PSU Bank Index is up 30 or 40% in the last 12 months. And the PSU Bank Index goes from strength to strength. And vaunted, reputed private sector banks such as Kotak Bank, such as HDFC Bank, seem to stumble. I find it a very interesting situation. And if I had to choose, I think I would say, given the difference in quality of management, given the difference in tech processes, I would say that we're getting to a point where across a range of private sector bank, attractive buying opportunities could open up soon. But I stress again by saying, I find the last 2 years of the sequence of events over the last 2 years, where a spate of private sector banks have been hit by various issues on a regular basis. I find it very interesting, and given the wording of the exiting chairman's letter at HDFC Bank, my point of view is that this is a power play as opposed to being a fundamental issue with regards to how the bank is run.
Two questions here from my end. One, it's a systemically important bank, and the way the RBI has acted in putting in an interim chairman reflects that. Do you think the government and the Reserve Bank, the regulator, will now be forced to have a much better, supervision of this bank, given the kind of power play which is now putting the entire system at risk? And second thing, from the growth point of view of HDFC Bank, for last 3 years we haven't seen much growth. The merger hasn't come out with enough synergies. The loan to deposit ratio is still at 100% and NIMs are under pressure as well. How do you see all these things?
Let's address the fundamental issue. I couldn't quite understand your point on growth, because from last I saw, and we look at the bank's results every quarter, on both sides of the balance sheet, they're growing at double digits. In a country where other banks are finding it incredibly hard to get deposits, HDFC Bank is collecting deposits, growing its liability book at double digits, and doing so without having to pay 6, 7, 8, 9% rates on savings accounts and FDs. So in terms of fundamental performance, both sides of the balance sheet.
Saurabh, apologies for interjecting. The only point that I believe Sajid was trying to make was the fact that the bank, when it merged, suggested that the housing book will only contribute to the growth lever. We have traditionally been very used to an HDFC Bank growing at maybe 18%. Now, I know the size of the balance sheet is large, but when you look at the 3-year CAGR on loan growth, it's not been impressive. And I think that's what he was alluding to. How long can these teething issues be tolerated? And of course, to a certain extent, management commentary too, in terms of NIM recovery and the like, hasn't translated. I believe that's what Sajid was referring to.
So let's just address that then. Last 3 years, system loan growth last 3 years has been around the 11-12%. HDFC Bank has kept up with system loan growth. As they had said during the merger, and as people like us had understood during the merger, if you take a housing finance book, which was funded by wholesale market deposits, and you throw it inside a bank where that housing finance book has to be now funded by CASA, it'll take a few years for the loan deposit ratio to move into line where you'd feel comfortable. Unfortunately for HDFC Bank and unfortunately for shareholders like us, that transition coincided with a massive drying up of deposits across India. As they've emerged from that in the last couple of years, we felt that progress was satisfactory. Hey, if the loan deposit ratio had been 80, I would have been happier. But loan deposit ratio at 100%, both sides of the balance sheet growing at 11, 12%, and the bank gradually bedding down into a new normal, we felt events were moving at a satisfactory level. Let me address Sajid's other issue. I agree with you, Sajid, there that given that this is a systemically important bank, given that the exiting chairman is saying he has some ethical concerns, I think it is but inevitable the central bank will have to look into it. I don't think they'll have any choice about that. It's reassuring to hear on that front that the board spent yesterday talking to the RBI, and the RBI seems at least implicitly to have blessed Keki's taking up the chairman role. Keki himself is a formidable figure in Indian financial services, as he said on your show 10 minutes ago. He wouldn't have taken the role had he felt there were ethical concerns. So things are moving in a predictable direction, and I think I congratulate the board on dealing with a really tough situation well, because they could have come on that call and said the chairman has resigned and we don't know what to do next. They're saying that we've gone to the central bank, we've appraised them for the situation, we have a new chairman who knows the bank well, and we move forward. But I agree with you that it's difficult for us to see over the next 2-3 weeks how the RBI stays away from the situation.
Okay, Saurabh. Okay, enough banking. Let me try to move on. So this move on the Nifty, right? We've had a decent move through this week. I can see you smiling. A little bit of relief there. But yeah. So this move on the Nifty. We've had 3 positive days. Of course, today negative because the global cues are negative. You're a great macro analyst, right, Saurabh? You view the global developments really well. Talk to us about how large of a drag is this entire energy basket on the Indian economy as well as on Indian markets as a whole. Give us the risk.
Yeah, look, I mean, oil going from 70 to 110 to the dollar in the space of a month is a big hit for India. It's a $40-50 billion hit for our economy. $40-50 billion is the best part of 2 percentage points of GDP, 1.5-2 percentage points of GDP. So it is a hit. Unfortunately for us, it looks with every passing week that the situation in the Middle East could drag out into what looks like now a multi-month affair. Each passing week, the situation is escalating, and Iran's hammering of Qatar's gas fields yesterday wasn't good news for us. I think we should now look at obviously the March quarter earnings will be badly affected. Discussions with our portfolio companies suggest that March will be a washout for many of our portfolio companies because gas availability dried up 2 weeks ago. But beyond the March quarter, I think we're looking now at a solid economic slowdown in India now, because $40-50 billion hit, $70 oil to $110 oil. In addition to that, gas shortages. So this is a difficult situation for our country. We as portfolio managers in India are doing 3 things. We've viewed pharmaceuticals as a safe haven for the last couple of years. In the current circumstances, pharmaceutical export-oriented pharma companies and intermediate suppliers, API suppliers to them, I think become even more of a safe haven. The whole hospitals, diagnostics, healthcare space is another safe haven to put money in. And thirdly, we're trying to see if IT services companies, given that they've been beaten up and given that they benefit from the rupee falling, can IT services companies also offer us a safe haven? So the classic IT, pharma, FMCG safe haven play, I think, is back on, given the seriousness of the crude oil and gas situation. And the other piece we're doing is Our reading is America benefits from this, right? They are now the world's largest owners of gas reserves. If you add Venezuela, they have 3.5 years of gas and oil and gas reserves. Their economy, the Mag 7, have been spectacularly resilient over the last month, and we are encouraging our clients to increase their exposure to our global compounders portfolio. So in India, IT, pharma, FMCG, and then encouraging our clients to say, go invest in American and European companies, both on the tech front, but more generally invest in diversify out of India into global plays.
Right. Saurabh, also keen, you've been vocal about the fact that India may not overall be the best market at the current juncture. Give us a sense as to the rationale logic for that, because valuations have come off substantially from where we were trading 24, 25 times earnings. We're now sub 20 times. What's keeping you sanguine with regard to Indian markets, if I can term it as that?
So look, the reason 4 years ago we started diversifying out of India, the reason we built up the global compounders portfolio, got ourselves an SEC license, built a fund in Cayman Islands, built a presence in Gift City to help Indians invest abroad. The reason for that was what we were detecting 4 years ago, and it continues to this day, is we were detecting Indian EPS growth, Nifty 50 EPS growth, no longer being the 15, 16% EPS growth that we were accustomed to seeing, say, 5-6 years ago. Before COVID, Nifty EPS growth used to be pretty regularly in the 15, 16, 17% mark. And that gave India good reason to have a premium over other emerging markets, right? So India enjoyed a PE multiple of 16, 17. Other EMs were at 11, 12, 13, right? But in the last 4 years, what we've seen is EPS growth for the Nifty is barely 5-6% in rupee terms. In dollar terms, 2%. And that's significantly below other emerging markets. And hence, we believe that India's PE would derate from the current 20-odd number to a, say, number around the 13, 14 mark. So PE derating for the Nifty, given that India's EPS growth seems to have slowed down materially compared to the pre-COVID era, a PE derating for the Nifty was what we feared. That seems to have begun in the last year or so. The PE derating of the Nifty seems to have begun. My reading is that it has some way to go. I think Nifty PE derating has some way to go, given that our EPS growth has been subdued now for the best part of 3 years. And given that unfortunate global developments mean it's not apparent to me that this year, the current fiscal, there'll be a significant recovery in Nifty EPS growth. So further PE derating of Nifty feels to me to be on the card. And that's why 4 years ago we built this business. And as much as we can and whatever voice we have, we've been urging Indians to diversify globally. In my case, I have half my money invested in India in names such as HDFC Bank. And I have half my money invested in a global portfolio. And my view was, as we mature as a stock market economy, as we mature as an investment community, it makes sense to diversify globally into developed markets. India is 3% of global market cap. Europe plus America is 70%. And therefore, I believe it makes sense for those watching to have a portfolio which is significantly invested in India. This country has good prospects for many years to come, but it also makes sense to have significant investments in developed markets.
Okay. Saurabh, thank you so much for coming to us this morning and speaking with us.